12, Part 3, Investment and Subsidiary Account Transactions. This is Ken Boyd, the owner of St. Louis Test Preparation. And what I want to do is go into a series of problems starting with this video that I recently got from a client, and this is a good way to introduce, first of all, the definition of what equity is, and then go through some transactions. So, Wells buys 30% of the common stock of Wilson for a certain dollar amount. Wells has the ability to exercise significant influence, which is a tip-off that Wells, the buyer, the parent, should use the equity method for the sub. We find out that the subsidiary's assets were recorded at this amount, liabilities at this amount. Now this is a little misleading because what this really means is that the question is giving you assets minus liabilities, which is the equity section or the net assets section of the sub's balance sheet, which you'll see in a minute. Any excess of cost over book value, that is, any excess amount paid over the book value of the sub's assets, were attributed to unrecorded patents, and those patents have a remaining useful life of 10 years. We'll see what we do with patents in a minute. During 2010 and 11, the sub, Wilson, has net income. And during 2010 and 11, dividends were paid. So the bottom line question, and I always suggest on exams that people read the last sentence first for these long involved problems. Read the last sentence first. What was the reported balance in Wells, the parent's investment in Wilson, investment in sub-account? So if you go to the equity method, and I picked Wikipedia, the equity method is, it says it's used by firms to assess the profits earned by their investment in other companies. You report the income earned, the value based on the buyer's share of assets. So your portion of the profit, if you're the parent, is proportional to the size of the equity investment, so Wells will get 30% of the profit. When do we use the equity method? When a company holds 20 to 25% of the company's stock, has significant control. So we go through that conversation as well. So what do we do when we use the equity method? The investor records the initial investment at cost, we'll see that in a minute, and then we adjust that cost, we adjust the value of that balance sheet item to reflect changes in the investor, the parent's share of the company, the subsidiary's income or loss. So we start off with January 2010, parent Wells buys 30% of the sub. So we create an asset account called Investment in Wilson, and we pay cash credit. Now, I pointed out a few minutes ago that Wilson's balance sheet was given, we were given assets and liabilities, so we can figure out the book value, the difference between the two. Blue minus green. So the book value being paid for is $3.4 million. However, Wells only buys 30%, and they pay $1.4 million. So what is the fair value of consideration that's paid? What percentage is bought by the parent? And what does that mean the fair value of the entire subsidiary is worth? In other words, what is the fair value of Wilton, the sub, based on the fact that Wells, the parent, paid $1.4 million for 30% of the company? Well, if you take 1.4 million blue divided by 30% in green, you get Wilton's fair market value about $4.7 million. Keep that in mind. We'll see that just a little bit later. Wells, the parent, gets a share of the sub's income. If I multiply 600,000 times 30%, there's the share of the income, and you'll see that it increases the investment account and is income to the parent. You'll also see down here in the T account, there's the $1.4 million that was paid. there's the share of the income, increases the investment account, and also creates income to the parent. Wilson's share of the dividend. Wells, the parent, share of the dividend. Well, they get cash, debit cash, and when they get the dividend, that's used to reduce the parent's investment in the sub, and we see in the T account here that we credit to reduce the investment in sub. That's because since the companies are assumed to be the same, if the sub pays a dividend, those are assets and cash going out of the parent as well, so we reduce the investment in sub. Same process in 2011. We have income and we have a dividend. Same deal, we multiply the percentage of ownership by the amount of profit. The amount of the dividend is the same. So I didn't repeat the dividend there. And so what we end up with is, we end up with a T account that has the beginning purchase. The T account for investment is increased by the parent Wilton's share of the income. It's reduced by the share of the dividend. Now, we have this amortization figure that we need to talk about. Remember that the amount paid in excess of the book value is considered to be an asset, which is a patent. That's why we paid more than book value. So the value of the patent is the 3.4 million, difference between the 4.6 million roughly, that's the fair value of the whole entity, the sub, minus the book value of the sub. It's about $1.26 million. We were given a useful life of 10 years for that patent, that asset, so we can figure out the annual amortization, the patent number in blue divided by 10. And we also realized that Wilton only has 30% of that amortization, so in green, there's our 30%. If I multiply the annual total amortization in blue by the percentage purchased in green, we get annual amortization of that patent that we bought, that we theoretically bought when we consolidated the company, of $38,000 a year. And we can see that in the asset account, investment in Wilton, the amortization expense goes to reduce Wilton's investment in the sub. So again, we saw three things going on here. We saw an initial purchase, we saw the investment account being increased by the parent share of the income, we saw the investment account decreased by the parent company's share of the sub's dividend, and finally we saw the investment account decreased by the parent's share of amortization of the patent. And the patent was the amount that was paid over the book value of the assets. You can find out more at the website stltest.net. Keep in mind that in addition to tutoring services, we have a page there. We also have the accounting video textbooks. We have one at this point for accounting for investments, and if you click on the link on the page, it takes you to a page where you can purchase a 3-hour video on accounting for investments. You can also get the Excel spreadsheets and a practice exam that is also answered in the video. Thanks very much for watching, and we'll see you next time.